Hey, this is Michael and welcome back to me and Paul's channel. In this video, I'm going to answer a question that I receive all the time. How does private lending work? Before we dive into this video, for those of you who are new, we talk about buying real estate, selling real estate, and all the strategies we use, like virtual wholesaling, buying and managing rental properties, whether local or out of state, renovation projects, private lending, and owner financing. So please subscribe to our channel because we have new videos coming out every week. With that said, I'm going to dive into today's video. How does private lending work? So we figured we start out with a Q&A format, kind of to answer a lot of commonly asked questions today in today's video. So the first question we're going to cover here is, what is private lending? And it's basically private money lending serves as an alternative to traditional lending institutions like big banks. Private money lending is when individuals lend their own, capital to other investors or even professionally managed real estate funds while securing the loan with a mortgage against the real estate or the property. Why would someone be a private lender? Leaving your hard-earned money in a savings account that's earning basically nothing on average, call it anywhere from 10 to 60 basis points right now, is no way to grow your assets. Private money lending allows you to earn anywhere from like 8 to 15% interest, and that money is secured by a loan. The money is secured with real estate that is worth much more than the loan. It's important to familiarize yourself with all the different real estate financing options you have available today. Why would real estate investors use a private lender instead of a bank? It's easier to fund a property using a private lender than applying for a bank loan. Banks have a list of strict requirements and long time frames. So a need for alternative lending sources quickly developed in the real estate industry. Private money lending is a critical component to the real estate investment industry. Its presence makes it more possible for the average investor to run and maintain a sustainable business. It allows us to make stronger offers and close faster and get more of those deals. So who are private lenders? Barely anyone can be. If you're a current real estate investor looking to expand your portfolio, so if you don't have enough deals, but you have plenty of your own money and others' money's on the sidelines, you could lend your money out at 10 to 15%. If you have a high income job like doctor, lawyer, CEO, etc., or just have a huge surplus of cash savings, whether it's in cash or it's a large sizable retirement savings account and you're looking for passive income, these are great opportunities for non-day-to-day real estate investors to lend their money to actually earn something on it and not just earn 10 to 50 basis points on it. How does private lending work? So the concept of a private money loan is relatively simple. You have three components really: a borrower, a lender, and paperwork. While they seem to serve the same purpose as traditional lending institutions, there are several key differences. Private money loans typically charge higher rates than banks, but they also are more valuable in cases than what an average bank would kind of like loan on. So usually not many banks will always loan on really distressed properties or fire damaged properties or whatever they may be, whereas a private lender would because they see the opportunity there. Additionally, private lending offers that speed to allows investors to make strong offers to close fast. How do you become a private money lender? Pretty simple: networking. You want to meet successful real estate agents and investors, and then talk to others that do private lending, and then work your way into your circle and figure out, what's a good fit to work with someone lending your money and what specific deals they have. What type of properties do I, privately lend on is another common question. With private money lending, you'll be confronted with several types of real estate investors, and there's multiple different scenarios that you may encounter. I'll kind of cover the 5 of them. One is transactional. So this type of investor will typically purchase a residential property and quickly resell it as is. The investor may only need your money for a day or a few weeks. Those are typically your wholesalers, where they might buy a bank-owned property and just look to resell it real quickly, and they need some funds for that. Another type of property type is a rehab and resell. So this type of investor will typically purchase a residential property, complete the renovations with the intention of reselling it once the project's complete. Borrowers in this sector find private money very attractive because conventional banks will often not lend to the properties in poor conditions. So lending on this type of deal will basically be 3 to 9 month turnaround time, depending on the scope of work and how long it takes to sell. Another example on how to lend your money is rehab and then rent it out. So these investors typically purchase residential properties, complete the renovations with the intention of renting the property out for cash flow purposes. So once renovations are completed, the investor will get the place rented and then apply for a loan from the bank at a much lower interest rate and pay you back. And lending on this type of deal, again, could be anywhere from 3 to 9 months. Another one is more kind of builders and developers. Builders and developers will purchase vacant land to permit and develop into residential or commercial use. Many banks won't lend on speculative development. So depending on type of development, lending on this type of deal will be maybe 1 to 3 years on average. And then the last one is commercial investors. This population investors may seek to use private money as a bridge loan for commercial property when a conventional bank won't lend to them on an unstabilized asset. So those are kind of the different types of lending scenarios that you're going to encounter: transactional, rehab and resell, rehab and rent out, and then get cashed out, lending to builders and developers, or commercial investing. So how do I get paid? So private lending is pretty flexible on how you structure the deal, and it could be equity or debt. So some of the ways, for example, are sometimes called joint ventures. So a private money lender can, especially on a rehab and resell, can kind of do a profit split. Is pretty attractive financing option potentially. So, the investors can negotiate to receive a percentage of the profits from this type of agreement. This amount is going to vary based on the contract, the investment, and how profitable it could be. But to use an example, if you lend $100,000 and rehab is another 50, so you actually lend $150,000 on the project. Your partner in the joint venture does all the work, manages all the project, and you guys sell it for 250. So the 250 minus any closing costs minus your 150, you're going to split that profit 50-50 if you agree to something like that. So that could be a bigger payday, but it's not guaranteed. You could lose money or break even on it. So you lent all your money and made nothing on it and tied it up for 9 months. Another type is sometimes you could, when you set up a loan more, it's you could throw in there exit fees and renewal fees. So if you private lend on a property for 9 months, and instead of doing a joint venture, you could receive interest payments, points, exit fees, and renewal fees. So I'll kind of cover these examples. First, we'll talk about exit fees and renewal fees. The loan structure, requires the borrower to pay a predetermined amount at the end of the term loan. The exit fee is often negotiated as a percentage of the overall price of the investment. And in some cases, the lender may even negotiate an increasing exit fee that changes depending on when the loan is paid in full. For example, if the borrower needs a few extra months to repay the loan, then they would pay a larger exit fee. Interest payments you could get along the way. This is the most common setup in private money. Lenders can set an interest rate at the time of the loan and then sit back and wait for the money to arrive. You could get monthly, quarterly, you're just getting paid your interest payments at the end of your term period. It's very flexible, and it's kind of like how you want to set it up. And then the last one is you could also charge points. So if you're loaning out your money, maybe you're loaning it out at 12 to 15%. You can also charge like 1 or 2 points maybe up front. Points are essentially fees paid by borrowers. Points are calculated as a percentage of your overall loan, with 1 point referring to 1% of the loan. The reason some lenders prefer this system is that points allow them to be paid in larger sums with additional interest payments to follow. More often than not, points are paid at the beginning of the loan term and are suggested by the borrower as an incentive for granting the loan. So to wrap up this video, private money lending can represent an attractive opportunity for both parties involved, the borrower and the lender. And real estate investors seeking alternative financing sources will have the benefits, including faster approval process, increased access to funding, which will lead to stronger offers on properties. On the other hand, those lending may find they have unique access to potential investments and deals they haven't had before. So no matter which side of the transaction you're on, private money lending is a viable option for expanding your financial portfolio. Hope this video was helpful, and let us know if you have any additional questions in the comment section and we'll address them. Thanks everyone, and have a great day.